Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So we finished the third quarter, and it's been a rough year. Both U.S. stocks and bonds down by pretty historically large amounts. Specifically, taking a look at point number two, big drawdown in bonds. Let's take a look back in history to see how abnormal this is. And finally, big jobs report for the month of September came out earlier today on Friday this morning here, and the stock market is not liking it, even though the jobs report was really strong. Let's talk a little bit more about why the good news was such bad news for the market. So first, let's take a look back historically. Every year since 75 here, we can see every calendar year that the S&P 500 total return was negative. And I think through 9 months so far, we're not quite out of the water yet, but I think it's safe to say, unless something historic happens during the fourth quarter, we're likely to have a negative calendar year for the stock market. Take a look at the middle column there, the Bloomberg US Ag Index. That's a investment grade U.S. bond index, accompanying essentially the entire U.S. market, similar as to the S&P 500, but for bonds, down 14.6%. Pretty interesting when you look back historically. It's never happened where a calendar year where both bonds and stocks were negative at the same time, at least since 1975. I think we're in for a pretty unique year, and I think the performance of the 60-40 portfolio shows why. In fact, this is probably going to go down. So far, it is the worst 9 months to the start for the 60-40 portfolio. It's on pace for 2008. Obviously, equities dragged down that portfolio at that point, but pretty historic combination of both asset classes performing poorly. Usually, bonds are used as diversification for that equity market allocation. Now, speaking of bonds, take a look every year again, back to 76 here. We have in the teal the index return for that U.S. aggregate bond index that we showed returns for on the previous chart. So you've got the calendar year returns in teal, and the orange is a max drawdown. So during the year, for perhaps the example was in 4% in 2021, that at the end of the year, the market was up 4%, but during the year, it had a 2% drawdown there. So far, the drawdown and calendar year return through 9 months, both the same at negative 15%. Historically, we've never seen anything like this in sort of the past several decades, with bonds down significantly, all related to obviously the above average inflation that we haven't seen since the 1980s and the rapid increase in the Fed funds rate and interest rates throughout the economy that obviously starts to push down bond prices as higher rates come into the market. Now, big jobs report this week, and there were a lot of eyes on it. We'd had about a 5% bounce off of the market lows for U.S. equities. Some people anticipating a soft jobs report, some bad news, might mean that the Fed was not going to be as aggressive as perhaps the market's pricing in. Well, I'm sorry, that was not the case. Jobs market is actually pretty strong. We had 260,000 jobs added during the month of September. That's slightly above analyst expectations throughout Wall Street. And if you look at the labor market, it's been pretty resilient. Remember, the Fed has two dual mandates, right? Keeping price consistent, inflation down to around that 2% target. We're obviously well above that, north of 8%. Labor market still very strong. The Fed's not going to slow down on raising rates until we start to see some weakness in the employment market, and we're not seeing that. In fact, the U.S. employment rate dropped to 3.5% from 3.7%, a sign that the jobs picture continues to strengthen, right? We have seen some increases in layoffs, but we have seen a lot of companies that are still short-staffed going out and trying to hire, and there's still a lot of open jobs versus the number of employees out there. And until we see that number come down, and until we see the unemployment rate start to go up, I think the Fed's going to continue to try to attack and bring down that inflation, knowing that they haven't hit the economy thus far with anything drastically negative, especially with the labor market, their second mandate. So the fact that the labor market is still very healthy gives the Fed the green light to continue to put their foot on the gas pedal or foot on the brakes rather, with higher interest rates to potentially bring down that inflation. I think market participants aren't a real fan of that, because that's not too good for equity market returns when interest rates are moving this rapidly to the upside. Finally, famed the late Robin Williams, a famous actor, obviously from the 90s and 2000s, and a ton of different movies. But one of his more famous movies, or maybe a little bit unknown, unless you're kind of watching that genre of animations, if you will, Aladdin, back in 1990, Disney film. He was the voice of a popular character, Genie. He only earned $75,000, surprisingly, for this film. It ended up grossing $500 million that year. Later, they sent him a Picasso painting to help satisfy that. I guess part of the negotiation was he said he didn't want his name out there on any toys or merchandise. That was part of the reason it was so low, but he did just want to participate. At the time, not a lot of big actors were doing voiceovers for animation, so a little bit of a trailblazer at that time. Now it's much more the norm. He later negotiated and earned north of $1 million for the sequel, so he was paid down the line, but I think they got a pretty good deal on what became a pretty famous character and helped drive sales for not only the toys, but also the movie and Disney in general. So RIP Robin Williams, great actor, great comedian, great in that movie and several others. With that, I want to thank everyone for watching, and I'll see you next time.